As of Friday, January 9th, 2026, the current live price of NVIDIA stock is 184.73 USD, showing a slight intraday dip of 0.31 points or 0.17% in mid-morning trading. While the broader market is watching a relatively quiet session, there is a massive gap between what the public expects from this semiconductor giant and the reality unfolding behind the scenes at the Consumer Electronics Show this week. Most investors believe the story of the year is the ramp-up of the Blackwell architecture, but the real breakthrough that just surfaced involves the Vera Rubin platform. This next-generation system is not just a distant promise. Reports from the floor in Las Vegas confirmed that Vera Rubin is already in full production. This creates a fascinating loop for anyone looking at online investment opportunities right now. While the casual observer sees a stock taking a breather after its historic run, the institutional players are looking at a platform that offers 5 times the inference performance of the chips we were all obsessed with just 6 months ago. Looking at the ticker on a platform like Robinhood or through a Fidelity brokerage account, you might see a stock that feels like it is cooling off. The common market narrative is that the low-hanging fruit of the AI boom has been picked. People think that because every major tech firm has already placed their multi-billion-dollar orders, the growth must slow down. That is the expectation. The reality, however, is that the demand pipeline for 2026 and 2027 has officially swelled toward a $500 billion backlog. When you look at the trading volume today, you see a significant amount of institutional repositioning. Large funds using Fidelity Wealth Management or complex interactive brokers trading setups are not necessarily dumping shares. They are fine-tuning their exposure to account for the Vera Rubin rollout, which is slated for the second half of this year. This new architecture uses high bandwidth memory 4, which is a massive leap over what we see in the current market. If you're using Schwab Intelligent Portfolios or a similar robo-advisor, you might be wondering why your tech weighting hasn't moved much despite these headlines. The truth is that the market is currently digesting the logistics of this growth. We have moved past the phase of wondering if people want these chips to the phase of wondering if the power grid can actually handle them. NVIDIA stock is no longer just a bet on silicon, it's a bet on the global energy infrastructure. During this morning's session, we saw a lot of activity on the Robinhood app from retail traders who are buying fractional shares, trying to build a position before the next earnings cycle. Meanwhile, the Fidelity mobile app shows a surge in interest for Fidelity ETFs that have a heavy weighting in the semiconductor sector. It is clear that the appetite for online investing remains high, but the strategy is shifting from speculative gambling to a more calculated long-term approach. Let's address the elephant in the room regarding current market pressures. We are seeing a bit of a tech rotation. Investors are looking at Apple stock and Tesla stock as potential catch-up plays, which sometimes pulls liquidity away from the semiconductor leaders. However, the reality of NVIDIA's business model is that it functions as a tax on the entire AI sector. Whether a company is building its own models or using third-party software, they are likely doing it on NVIDIA hardware. This is why when you check your individual brokerage account, you shouldn't be surprised by the volatility. High-growth stocks often go through periods of consolidation by time, where they trade sideways while the earnings catch up to the valuation. Currently, the price-to-earnings ratio is sitting around 45, which sounds high to a traditionalist, but when you factor in that earnings are expected to grow by another 60% this year, the PEG ratio actually looks quite attractive. For those of you managing your own portfolios through SoFi Invest or Interactive Brokers, the technical levels are worth noting. We are holding above the $180 support level quite well. If we stay above the recent low of 178, the bullish structure remains firmly intact. This is the kind of detail that matters when you are involved in self-investing. You have to be able to block out the noise of the daily fluctuations and look at the underlying health of the business. The company just announced a partnership with the South Korean government to deploy 250,000 GPUs for their national AI project. This isn't just a corporate deal, it's sovereign-level infrastructure. When countries start treating computing power like they treat oil or gold, the ceiling for what a company can be worth starts to disappear. Please take a second to head down to the section below and comment on how many shares of NVIDIA stock you are currently holding in your portfolio. I'm curious to see how many of you are long-term holders versus those just getting started with Robinhood stock trading. To understand where we are going, we have to look at what this company actually does beyond the headlines. NVIDIA started in the early 90s with a simple goal: making video games look better. They invented the GPU, which allowed for complex 3D rendering. For years, they were just a gaming company. But about 20 years ago, they made a decision that changed everything. They created a programming language called CUDA. This allowed researchers to use their gaming chips for scientific math. That was the spark. Fast forward to today, and that same architecture is what powers ChatGPT, autonomous vehicles, and drug discovery. Their business model has shifted from selling a chip in a box to selling an entire AI factory. They sell the chips, the networking cables, the software, and the cooling systems. It's a full-stack solution that is incredibly hard for competitors like AMD or Intel to replicate. When you use interactive brokers' fees as a benchmark, you realize that professional traders are very sensitive to the costs of staying in these high-momentum names. They aren't just buying and holding, they are hedging. We are seeing a lot of put option activity as a form of insurance against a potential broader market pullback. But the reality of the Blackwell ramp is that it's exceeding even the most optimistic forecasts from late last year. Management confirmed that Blackwell systems are essentially sold out for the next 12 months. This creates a scarcity premium. If you are a cloud provider like Google or Amazon and you don't get your NVIDIA chips today, you might have to wait until 2027 to catch up to your rivals. That is why they are willing to pay top dollar and wait in line. It's also why many people are turning to investing sites to find any way to get exposure to this growth. There is a tension here between the market's expectation of a cooling-off period and the reality of a re-accelerating roadmap. Usually, tech companies release a new product every 2 years. NVIDIA has moved to a 1-year cycle. This is an incredible pace that forces the competition to spend billions just to stay relevant. If you are looking for investment help, the most important thing to realize is that the moat around this business isn't just the hardware, it's the millions of developers who are already trained on their software. Switching to a different chip isn't just about buying new hardware, it's about rewriting millions of lines of code. That is a massive hurdle that keeps customers locked into the ecosystem. We are also seeing a major development in the Chinese market. Earlier this year, there was a lot of concern about export restrictions, but the reality is that a new licensing deal for the H20 chips has been approved for mid-February. This reopens a multi-billion-dollar revenue stream that was previously thought to be lost. For anyone using SoFi Active Investing or a Fidelity trading platform, this is a major catalyst to watch. The Chinese tech giants are desperate for this hardware to keep up with Western AI developments. When those orders start hitting the books in the next few months, we could see a massive revision in earnings guidance. As we look toward the future, the outlook is framed by 2 possible scenarios. In the optimistic scenario, the transition from Blackwell to Vera Rubin is seamless. The supply chain issues that plagued the industry last year are resolved because the company learned how to manage server-level manufacturing during the Blackwell rollout. In this scenario, we see the stock challenging its all-time highs of $212 and potentially pushing toward the $250 mark by the end of the year. The pessimistic scenario involves a slowdown in capital expenditure from the hyperscalers, the big tech companies that buy these chips. If they decide they have enough capacity for now, we could see a period of stagnant growth. However, given that we just saw details of the Rubin Ultra and Feynman architectures planned for 2027 and 2028, it's clear the company is not planning for a slowdown. In summary, what we are seeing today is a classic case of the market catching its breath while the fundamentals continue to sprint ahead. The expectation was that CES would just be a series of minor updates, but the reality was the unveiling of a production-ready Vera Rubin platform that makes previous generations look slow. We have seen a shift from a hardware-only story to a sovereign infrastructure story. Whether you are using a Robinhood app, Fidelity IRAs, or managing an interactive broker's account, the key is to understand that the volatility we see at the $184 level is the noise, while the $500 billion backlog is the signal. The contrast between the quiet intraday movement today and the massive strategic leaps being made in high-performance computing is where the real opportunity lies. Most people are waiting for a clear sign to buy, but the signs are